Welcome, fellow business brokers. Thank you so much for joining us today. I'm really excited about our topic of a conversation that we're having today because we've all heard about the Payroll Protection Program. We've heard about EIDL. We've talked about that over the last few months, but there's a program that a lot of us do not know about, and that's the Main Street Lending Program. And that came out March 29th, just like the PPP and the EIDL did with the CARES Act. And talking with a lot of business brokers, not too many know about the Main Street Lending Program, and it's kind of unique. It's not going through the Small Business Administration. It's actually through the Federal Reserve, and it's really not for acquiring businesses, but we'll get into that. And I'm just really excited to talk about this today. And I do want to tell you that there are some pros to this program, but there's also a lot of cons to this program. So this isn't about just pumping up the Main Street Lending Program and telling you how wonderful it is, because it is not wonderful. There are some warts on this, but at the same time, as business brokers, we need to know about all the programs out there so that we can talk intelligently to our buyers, we can talk intelligently to our sellers, and it's another tool in the toolbox for us to get deals done. But before we begin, if you're watching this on YouTube, please support the channel and please subscribe to the channel below. Would really appreciate it. And that way you're not going to miss any new upcoming videos that we got coming out. We got some great ones on the schedule. So before we begin, let me introduce our two panelists that we have today. First, we have Dale Armour with Acquisition Experts. He's in South Florida. Great guy. I really respect Dale. He's a fantastic business broker, and I consider him a really good friend. Dale, thank you so much for joining us today.
Thank you for having me. Appreciate it.
Thanks, bud. And we also got Jimmy Neal with Live Oak Bank. How you doing today, Jimmy?
Doing great. Thanks, Jim. Thanks for having me.
I really appreciate you joining us today, Jimmy. Live Oak Bank. Tammy Teese passed on Jimmy Neal's name and number for me. I really appreciate it, Tammy. So shout out to you at Live Oak Bank. And Jimmy, I really appreciate you joining us there. Live Oak Bank has done a couple of these Main Street lending programs now. So really excited about that and see the insight about the program. But I want to first start off with you, Dale. And the reason I have Dale on, he's a business broker in South Florida, like I said. And the reason I have Dale on is he actually just completed, how long ago, Dale?
Just the middle of last month.
A month ago, he did a deal that involved the Main Street Lending Program. So how did you find out about the Main Street Lending Program?
It was referred by the lender. I'd worked on a dental lab acquisition of one dental lab, acquiring another one. The transaction started November of 2017, was taking a while to get done. And we were supposed to close March 31st of 2020, and March 23rd, the lender pulled the plug on the program. It was an in-house loan. They got uncomfortable. They said we'd reevaluate in 60 days, and 60 days later, they offered the buyer the option of going back to their in-house program or evaluating the Federal Reserve Main Street Lending Program.
Okay, great. So why did your buyer decide to go on the Main Street Lending Program? What was his decision on there?
So when he weighed out the closing cost and the terms of both loans, it just looked like a much more streamlined, easier, better way to go. No, personal guarantee. They didn't encumber. He signed a personal guarantee, but they didn't encumber his real estate. It had
his home, his residential home?
Yeah, multiple properties. Closing costs were lower. Just signed a personal guarantee, put collateral on one of his business locations, and that was it. It had a very low interest rate. It was a very streamlined program, and basically gave him the opportunity to have a bridge loan and refinance the transaction later and get it done quickly.
Great. Okay, so let's back up. How did this all happen, Dale? Give us a 5-minute little spiel about the whole thing, because I think it's really interesting. You got the deal done. It was a $2.65 million deal. You got it done. You told me offline that you don't think you would have got it done without the Main Street Lending Program. So just kind of give us a rundown of the whole deal.
Yeah, so the bank got super nervous about putting their money on the street during COVID. They pulled the deal. They said
for the SBA. You were getting an SBA loan, right?
It was an in-house conventional loan.
Oh, conventional loan. Okay, my apologies.
With a high net worth client making an acquisition within his own industry, but they were nervous about putting their money on the street. They had collateralized him to the hilt. When we weighed out the two programs, they were just vastly different, and basically I think they had to have kind of, the mentality that it was going to be a bridge loan for 5 years. And they had an exit strategy where they were just going to refinance the real estate out of the transaction to pay off the Main Street loan. And then he would just have a real estate loan with their bank. So, overall, the transaction made sense. He had a profitable business, buying another profitable business with real estate, and it was just best suited for, the overall terms and conditions of the proposed transaction.
All right, excellent. I appreciate it. And Jimmy, maybe you could give us a little, brief overview of exactly what the Main Street Lending Program is.
Sure, I'll give it a shot. So the Main Street Lending Program was established through the CARES Act. It's basically for mid-sized businesses, maybe some of those businesses that initially didn't qualify for PPP, but so really they've kind of adjusted over time, and small businesses to mid-sized to large businesses, and really the criteria is less than 15,000 employees and less than, maybe it's 5 billion revs, or 15, but so most every mid-sized business in America qualifies. We look at affiliates and subsidiaries to make sure they qualify. But essentially the Main Street Lending Program is based, they stated that the intent was to use the money for working capital and payroll expenses. And that's the first paragraph of the FAQs. For anyone that's interested in learning more about this program, you go to the Boston Fed's website. Just Google Boston Fed or Google Main Street Lending Facilities or Main Street Lending Program. They've got some good information. They've got FAQs. We also have borrower certifications and covenants and a borrower term sheet. Those are the three main documents that you want to study, a little over 100 pages. So the intent of the program is to provide working capital for businesses impacted negatively by COVID, although businesses that aren't impacted negatively by COVID are also eligible. So it's a tricky little program. It's a new program. It's not like an SBA or an economic injury disaster loan that have been stood up and set up for many years. It's a new program. A lot of banks were skeptical. We've had to learn, get comfortable with the program to make sure that our risk is actually mitigated with the 95% participation that the Fed purchases from the bank. So in every case, there are actually 4 types of loans through Main Street: a Main Street New Program, Main Street Priority, Main Street Expanded, and Nonprofit. I'm most familiar with the New and the Priority programs. It's really a multiple of 2019 EBITDA, less all outstanding debt, and that's what you're eligible for. So the new program is essentially you just need additional working capital. You're not trying to refinance any debt. The Priority program, a little higher multiple of EBITDA, 6 versus 4 with the new, and that allows you to refinance some debt and remain in a senior secured position, or if you're doing a partial refi, or you're not refinancing all of the debt, it mandates that you must be in a senior secured collateral position and or share pari passu with the existing lenders. So really working capital loans. It's funny, as a bank, we are not, Live Oak is not counseling borrowers or potential borrowers on uses of proceeds. We're encouraging outside counsel. The program tells you what you cannot do with the money. It's a little gray as to what you can do with the money. So to that extent, we've seen some pretty creative things our way and by way of outside counsel.
And then, so Jimmy and Dale, as far as us business brokers, because what we do is we help people buy and sell businesses. Obviously, this program is not really a program designed to go out and necessarily buy a business. It's to expand an existing business. So the buyer, or not, I shouldn't say, the borrower has to own a business already. Okay, so this doesn't work for somebody that just wants, an individual that just wants to buy a business. This has to be somebody that already owns a business and they're looking to expand the business by acquiring another business. That's where we could fit in the Main Street Lending Program could fit in, is that they're acquiring this other business, but they have to already own a business. And actually, they don't, when the target business that they're looking to purchase, that is not, you don't need any financial paperwork from that business at all, right? It's based solely on the borrower's business, correct? And has nothing to do with the seller's business?
Correct. In my instance, we did the 4 times EBITDA. He was a dental lab with a $700,000 EBITDA. They said he was, less his debt was only a $150,000 line of credit was the only debt he had. So he was, he had up to $2,650,000 available. He chose only to borrow 2.2. He had the rest covered. And so he was a profitable business. So I think it's great for an industry acquirer doing a roll up or tuck in, or just for general business expansion.
Well, if you're an individual buyer you have an individual buyer that's looking to buy a business, this is not the loan for them. This is not the path to go down. I just wanted to make that very clear. Okay.
Yeah.
And then we're talking, I'm sorry, go ahead, Dale.
It's not like a 7A where it's reliant on the seller's cash flow. This is reliant on the buyer's cash flow. And like he said, we didn't have to identify what he was doing with the proceeds at all.
Right. And so you're just using the financials of the borrower, the buyer, and none of the target businesses being bought. It's not like an SBA loan.
Correct.
Okay, great. So, Jimmy, can we expand a little bit more on the criteria to be accepted? Like the financials are for 2019. I know you need financials for 2020, but they're basing the EBITDA, the four times EBITDA off of 2019, correct?
So the two programs, let's talk about the new program and the priority program. You're basically looking at 2019 EBITDA, and we're asking the borrower to help us calculate that based on what they think it would be, and then we'll use our customary and traditional ways at the bank. If it's a new program, they're eligible for 4 times 2019 EBITDA less all outstanding debt. So, for example, if EBITDA is $1 million, 4 times $1 million is $4 million. Less debt, let's say they had $2 million in debt, they would be eligible for a $2 million loan.
Okay, and that's Jimmy. Let me stop you right there. And that also includes you subtract out any EIDL or PPP loans they got as well, right? With
Correct.
that, okay.
An economic injury disaster loan and a PPP loan are both considered debt. Mm-hmm. Now, the PPP loan, you could do if you feel relatively satisfied that or confident that the PPP loan will be forgiven, then you could potentially carve that out and set that aside. So you really never want to completely exhaust all the debt, take it to the very end. But if they had $2 million left and the PPP loan was $300,000, you just want to make sure that you could certify that they were going to use the dollars if the PPP loan was not forgiven to take it out.
Okay, and that EBITDA, that's not it's not an adjusted EBITDA. Like it's straight EBITDA number. Like you're not adjusting for personal expenses or anything like that. It's straight earnings before interest, tax, depreciation, amortization, right? Us business brokers add stuff back and add back personal expenses. The business owners running through the business. You guys don't take any of that into account, correct?
Well, the Fed's guidance is calculate EBITDA how you normally calculate EBITDA. So if you identify some one-time expenses, you could add those back. But I would be cautious to add back personal expenses that somebody might be throwing through. So, one-time expenses absolutely qualify.
Yeah, and this is the Federal Reserve and not the Small Business Administration too. Okay, so what kind of credit score do you look at for them, and what kind of criteria that is you guys at Live Oak Bank looking for?
Each bank wants to look at their typical underwriting standards. The Fed said initially that you need to rely on your customary underwriting policies and procedures, and we have done that. Last Friday, a week ago Friday, they came out and said they sure would like for us to loosen our underwriting criteria, and as long as the business could cash flow a loan, then we ought to make the loans. But again, that's not really in writing. That was a Wall Street Journal interview from the Fed chairman. So each bank that processes these will process them through their business and industry or conventional policies, and then they'll go from there. So if the credit score is in this 700, 750, probably stronger than an SBA loan since it's It's not 100%. It's not a guaranteed loan from the government, even though the Fed will buy 95% of it. That's kind of what you look at. We at Live Oak will look at, our policy says that we're going to take personal guarantees in almost every instance, unless there's a really significant collateral coverage, real collateral coverage with either commercial real estate or machinery equipment. And it is going to be fully, recourse.
And that's your bank requirement. That's not a requirement of the Main Street Lending Program, right?
Correct.
That's left up to the lenders.
That is correct.
And that's what happened in my case. The bank wanted to cover their 5% exposure, and it was a high net worth client that was already their banking relationship client. So they required a personal guarantee, and they put a lien against that FF&E of one of his labs. He owns 4 labs, so just on one lab, and they were comfortable with that.
That's pretty good for the bank. I mean, 95% protection, only 5% exposure. That's pretty cool. Hey, Jim, maybe we could talk a little bit about the terms of the Main Street Lending Program, the years.
Terms, but first of all, the fees, there's a 1% origination fee that goes to the bank. There's a 1% fee that goes to the Fed. The bank gets 25 basis points for servicing the loan for the 5-year term. The term of the loan is a 60-month term. The first year, there is no payment. And there's interest-only payments from year 2 through the term at the end of month 60. There are 3 principal reductions. At the end of year 3, there's a 15% reduction of the principal. The same at the end of year 4, 15% reduction. And then at the term, month 60, there is a 70% reduction in the principal. Our bank underwrites these loans with a 6.5-year amortization. So that's how we are looking at it. So if it cash flows over 6.5-year amortization with the interest rate of LIBOR plus 90-day LIBOR plus 300 basis points, that's what we're choosing to use. Then
I'm sorry, Jimmy, say that again. LIBOR plus what?
300 basis points, 3%.
Okay, great. So, and LIBOR right now is like 0.4 or something, right? So you're looking at 3.4. That's 30-day. I don't know about 90. You said 90-day. I don't know what 90 days.
90 days. It's around 0.25, 0.3.
Okay. So it's a very good interest rate. I mean, better interest rate than an SBA loan, it sounds like, right?
It is.
And the origination fees sound cheaper, right?
The total fees, 2%. SBA, you're probably blended above 3%, depending on the amount of the loan. But yeah, so in our case, our bank has a minimum loan amount just at $2 million. So we're going to consider things from $2 million and above. Our average loan that we're looking at right now is about $10 million.
Okay, great. Yeah. So let's get to that. I know that, and everybody that's listening, I want you guys to know that we're going to talk about 2 scenarios. We're going to talk about the one scenario of what the Federal Reserve has laid out, what they want to see. And then just like SBA loans, it's the same situation. The banks can then build what they're looking for on top of that. So the Main Street Lending Program, it's saying that you can get a loan anywhere from $250,000 to $35 million, right?
In that case,
Yeah.
50 million, I believe, is a priority loan.
Okay, and then you guys, Live Oak, you guys are looking at 2 million and above, and prefer to see 7 million and above, correct?
Well, 2 million is really the minimum.
Minimum for you guys, but 250,000 normally, if
for any other bank, yeah. So the minimum, you cannot sell one to the Fed for less than $250,000 loan.
Okay. And I don't know if this would really fit for a business that's 250, with a $250,000 loan anyways. I think it would be more into the multi-million-dollar situation. So is this is not forgiven, right? It's not forgiven like the PPP
It's not.
is.
No, it's a real loan, and it's got to be paid back. The Federal Reserve stood up $600 billion for the Main Street program, levered with the Treasury. So the Treasury is going to guarantee, I believe it's 700 million of the 600 billion. To date, only about $1 billion have been participated or purchased by the Fed. So in a lot of eyes, if you're looking at PR and you're reading the newspapers, it's been disappointing that the money hasn't gotten to the street much quicker, but I think it's by design of the program, to be honest with you.
Okay. Yeah, and I want to
try to loosen it up a little bit.
Yeah, I want to go over the cons in a little bit. The program expires what, December 31st of this year?
It does, December 31st. There's a good chance it'll be extended, but right now it sunsets at December 31,
Okay, and but you think it will be extended?
in
Is
my
that the word
opinion.
on the street among bankers? Is that what you
That's
guys are
yeah,
hearing?
that's what we hear on the street. Yeah, it was supposed to sunset tomorrow, but they extended it 3 more months. I think it's political, right? You got your political year, and if businesses need the money and they want the money, and banks are willing to facilitate it, I think the government's gonna open the window for at least another 30 and 60, 90 days.
See, this is a situation when we start getting the negatives here. You know what? What is there's like 3,700 and some banks in the United States that do SBA lending, and then as far as the Main Street Lending Program, 585 banks have signed up for the program to build to be lenders for it. But there's only been a handful, I think less than 20 banks or so, right across the country that have actually lent money on this program. What do you think is the downside that the banks are looking at that they're not getting more involved in this program?
Well, I think it's a risk. Look, we're still in COVID, right? In most of the states, and in a lot of industries, we don't know how quickly it's going to come back, and if there's going to be a relapse. And it's with the interest rates at right around 3% and small origination fees, to learn a new lending program and one that might potentially have risk of putback. So even though the Fed's participating 95%, a lot of banks are nervous that if you don't do something right, then the Fed could come back at a later date and say, you know what, we're going to ask for that money back. Now, we feel at our bank that we're trying to do everything exactly as the Fed has asked us to. So we've gotten more comfortable with that, but a lot of banks are not. A lot of big banks don't feel comfortable with that. And look, the last thing you want to do is in 3, 4, or 5 years, have to go to the Fed, who's not allowed to take a loss, and figure out how to liquidate and recover these dollars. Especially if if the Treasury's levered up 700 million and those dollars are gone. We don't think that's going to happen, but it's just tricky.
Yeah, you have to relearn, and like you said, a whole new lending program, and it takes a lot of time. It takes a lot of legal research, and takes a lot of time. And you brought up a good point about the big banks. I mean, from what I've gathered from talking to a lot of people and doing a lot of research, the big banks. I'm not going to mention them, but everybody knows who the big banks are. They're not doing this program. It's mainly the community, the smaller banks that are doing it. Correct?
I've seen a few, top 15 banks pop up that they might be doing it. But the truth of the matter is they're trying to focus on their main products. We've been focusing on our SBA product through trying to get them fully funded by tomorrow to take advantage of the 6-month P&I payment from the government. And, every bank has their priority through this COVID period, take care of our existing customer with deferrals and any assistance we can get to help those businesses stay afloat. So every bank has a little different take on it. Look, I think that this is probably a pretty good program, but it's not for every borrower. You've got to be really strong pre-COVID, and I think that we would like to see that your business is absolutely going to recover in the next year, and we want to have a relatively confident stance that it's going to get back to 85, 95% of where it was. So. This is a great program for a lot of businesses and industries, but we're still on pause with many, like hotels, for example, and restaurants. We'll do some, but it's look, we in banking are nervous right now, just like a lot of people. I think there's a lot of great opportunity, but we're still moving cautiously.
I think like any loan, it has to make sense. Like in my transaction, they borrowed 2.2. When he pays off the 30% by the end of year 5, he owes 1.6. The real estate's worth $1,750,000, and they can refinance the real estate out of that, and they covered their 5% exposure. I don't know about the other back end you mentioned where the banks are nervous about, but I think to them, with the allocation of the purchase price, and it was at 3.3 also, by the way, is what that one was written out on the interest with the LIBOR plus the 300 basis points. That's what it came out to. But I think like any loan, it has to make sense. And,
Sure.
our transaction made sense to the bank.
Yours involved real estate. There are a lot of businesses that don't have real estate. Think
Right.
consulting, think software. And if they want to borrow $10 million with no hard assets, it becomes difficult, at least for our bank. Not all banks, but for our bank, even with only 5% exposure.
But interestingly enough, all they asked for was a personal guarantee in the UCC. You know, they didn't tie up any real estate like they were going to in the conventional loan.
Personal real estate or other real estate holdings. That's interesting.
Yeah.
Let's go through the pros of the loan first. You know, pros from a borrower or a buyer's standpoint. You know, from what I hear, I know there's a lot of paperwork on your end, Jimmy, but it's less paperwork than an SBA loan for as far as the buyer goes, correct?
Yeah, most banks are going to just run this through their typical conventional loan program. So you're going to have a lot less documents to fill out and sign. But there is additional certifications that you're going to have to make. There is a, excuse me, a borrower certification. I believe it's about 15 plus or minus pages. And you're going to have to certify some things. For example, you're going to have to certify that you're not going to take profit distributions for the life of the loan and potentially up to 12 months after the life of the loan. The only distributions you're allowed to take per the certifications are those to pay income tax liabilities. So, you know, in a lot of cases, that's a hard stop for a lot of businesses that are pretty successful right now. There are no prepayment penalties. So look, if you want to pay the 2% fees, the 1% to the bank and 1% to the Fed to have these dollars, and turns out you don't need them, you can pay it back with no prepayment penalty.
All right, great.
It's interesting you mentioned that. Sorry, Jim, but in my client's case, they increased he and his wife's W-2 salary because they knew they weren't going to be able to take the distributions. So there's always a way within reason, you know, to work on that. And they counseled with the bank and with their accountant, and you know, that was their solution because they did take distributions prior, and they did have to take that into account.
I got some of these things down for pros, and tell me if I'm missing any or if I'm misspoken, guys. But pros, I've got, you know, less paperwork for the borrower, not as much fees as the SBA. Interest rates are lower, tend to be lower than the SBA. Don't need, you know, collateral. May not even need to put personal guarantee. Now, reminder, every bank is going to be different. So bank could look at this different. I'm just kind of giving you what the criteria of the Federal Reserve is. No documentation on the target business, because remember, it's the borrower has got to own their own business. They got to be buying, they've got to be expanding their business. They're not looking at the seller's business because they don't care what the funds are being used for. And then, you know, the banks are being 95% guaranteed. Is there anything I missed as far as the pros, guys, on that before we move to cons? Okay, we're going to move to the biggest con. Let's move to cons, but I think Jimmy, you know, mentioned one of the cons already, and that's the you can't take any kind of distribution for not only the 5 years that you have the loan, but for 12 months after that. And so you can only take it by W-2 salary, right, Jimmy?
Well, I would just encourage any borrower to read the certifications. I mean, there is some restriction about, you know, gamifying the system. If you're taking $200,000 salary and all of a sudden you take a $2 million salary, I'm not sure that would pass muster. But
Yeah.
you know, again, we're not the police of the program. We're just want to encourage you to read the covenants, the certifications that you make to the Fed.
I thought you could only take up to $400,000 on W-2 salary. Am I mistaken?
Yeah, 400 is a max, and there are restrictions on much highly compensated officers pre-COVID as well. So again, it's, you know, I think that's going to be the minority of cases, but we're just encouraging everybody to read them prior to going too far down the path.
And it's more legal paperwork for you guys, and it's you know, a lot more reporting, right, to the feds, or.
Well, the Fed has asked for certain reporting guidelines. I mean, our conventional reporting guidelines are pretty typical of most banks, I would think. Quarterly financial, quarterly metrics, managing covenants, you know, a handful of covenants. We're not putting 20 out there. But yep, there's definitely a portal that we have to submit to as part of the servicing requirements for the Fed.
What time frames have you seen to put these together? I mean, we did ours in approximately 60 days. Does that sound more or less like the time frames you've worked?
I think that's pretty reasonable, Dale. You know, for most SBA lenders, this has been a pretty pretty backed up month, right? We're trying to fully fund everything we can by tomorrow. I think things are going to ease up a little bit. I think the fourth quarter is going to ease up, and I think 60 days is very reasonable. But I think we funded our first one in less than that. I think it was just over 40 days. So I think the time frame to fund and process is going to be much less than an SBA loan.
Okay. All right, great. I'd like to take some questions from people that are listening today. If you guys want to raise your virtual hand, do that, and then I can chime you in, and you'll just have to unmute yourself when I tell you you're on. Or if you're shy about doing that, you can always do a Q&A in the chat box below, or in the Q&A section. Some of these questions, I saw them popping up as we were talking, and somebody was asking who monitors the loan during the term of the program.
So the bank services the loan. We will essentially monitor it for compliance with covenants. It's a great question. If we see profit distributions on a tax return, is it our responsibility to report that to the Fed? Probably. Again, I don't think that we want to be the police of the Fed's requirements for that certification. Again, new program, right, Jim? So we're trying to work things out with the Fed. Right now, we're just trying to get money on the street, and I think we'll figure out the fine tuning of servicing the product here.
I like that attitude, Jimmy. I like that. I mean, that's what business owners need right now. That's what people need. And so they can refinance this loan at the end of the program, correct? I mean, Dale, you're doing it with the 504. Could it be done with an SBA in 5 years? Make it an SBA loan, pay it off?
Yeah, you could refinance this with any product. I think a lot of people are looking that way. Of course, we want to underwrite with our standards of being able to have enough cash to pay it off, right? So no payment for a year, interest only for 4 after that, very low interest rate, stockpile some cash, potentially pay, although it's discouraged to prepay the loan, but put the cash away so that when that final payment, 70% is due at month 60, it can be had.
Great. All right. Hey, well, we see Roberta on the line, my good friend Roberta. How you doing today, Roberta?
I'm doing well, thank you, gentlemen. Dale, nice to see you. How are you, Jimmy?
Hi, Roberta.
So
Nice.
I have a quick question about, first I was going to ask you about prepayment if there were penalties, and you just addressed that. And the other is, I must have missed it, what the actual interest rate is, say that if that loan were closing today.
So banks are allowed to use either the 30-day LIBOR or 90-day LIBOR plus 3%. We're using 90-day LIBOR. It's arguably negligible, the difference, 10 basis points. I haven't studied the rate this week. So that's the rate.
All right, thank you. This is great. This is so exciting. Dale, really, thank you. Kudos to you because you're enlightening all of the BVF. Is that not so, Jim?
Yeah, I mean, Dale got a deal done about a month ago, $2.65 million deal done because of this program. It was falling apart.
Yeah.
It was dead in the water, and because of this program, he was able to close on it. So,
and he was kind enough to share it with the BVF membership.
Absolutely.
Awesome.
Yep.
Yeah, it was a rabbit out of that hat, and thank God for the stimulus programs that were put through the Senate, and all the programs that help small business and us, the PPP and the 6-month forgiveness on the 7A loans. I know our company took big advantage of that, and we had a lot of buyers pushing for that, and I'm really sorry that ended. And I was kind of wondering, Jimmy, if you knew anything about, is there any talk about extending that or allocating more funds to it? I mean, this Main Street Reserve program is hardly being used, but that 7A program with the 6 months forgiveness is being heavily used. And my personal opinion is the IBBA, BBF, and BEEF, the Business Intermediary Education Fund, need to really, push or have a voice in trying to
Sure.
extend. Have you heard anything about that?
You know, we're one of the largest SBA lenders in the country. So we have our heart to the pulse, our ear to the pulse. You know, our political action team is very close to the legislators. We want to say that we were probably influential in some of the PPP language, and you know, it's just speculation at this point as to what's going to happen. You know, there was a good chance for some enhancements to the SBA program, and then the two sides of Congress couldn't get along, and so that was shot down. Now I think they're trying to resurrect some things. Who knows what's going to end up being in it? Ted Cruz had some pretty good language. I mean, how good do we think it would be if the SBA guarantee went to 90%? That would be pretty good for incentive, right? And then what if they waive the SBA guarantee fee, right? So those are some rumors that we've heard. What if they raise the SBA eligibility from 5 million to 10 million? Again, those are things that, again, all rumors, all unsubstantiated, but have been in discussions. And so we anticipate there will be some things like that in the next stimulus bill, we hope. Right now they're focused on forgiveness, right? So now the forgiveness process has many banks bogged down. It's a lengthy application, and then we have to submit it to SBA. SBA has to approve it. We're hoping that there's some legislation that says, okay, everybody who has a PPP loan at this level, you just have to certify that you met all the requirements.
Attachment letter. And I just want to remind everybody that's listening, we do have a petition going around. We've had over 2,000 signatures on it that's supporting that congressman, and I can't remember his name, he's out of North Dakota, supporting his proposal that all PPP loans under $150,000 are forgiven with a simple one-page attachment letter signed by the borrower, and it's just automatically forgiven. So make sure you sign that petition if you're not already signed that petition. And by the way, that's like 85% of the loans, the PPP loans out there, were $150,000 or less. So anybody else want to raise their virtual hand, you know, go ahead and do that. Roberta's coming on, and again, love to have you on, Roberta. Let me bring you in. Hey, Roberta. Roberta?
Jim?
Did I cut you off before you
I
were done?
don't know. I think you might have.
I apologize. I'm so sorry.
No, what you just mentioned something so important, but you didn't let us all know where we could go to sign that document.
All right. So you can email me at Jim P. You know what? You can go to I hate to do this, but you can go to my website at bossgi.com, bossgi.com. And we've got it up on the website where you're not even on our website. It just goes to that page where it has a link that you can click to go sign that petition, because that's the quickest, easiest way. If I give you the link that's actually to the petition, it's like really long with a lot of numbers and weird characters and stuff. So just go to bossgi.com, and there's a link right there. You can't miss it. Click it and sign
We should
that.
probably all put it on our websites and perhaps
We
on the
should.
PDF also.
We should. You're
Good
right.
idea,
That's-
Roberta.
And put it on your Facebook and your
It would be
LinkedIn
nice to
pages.
have a national initiative to get that out and circulate it. All right, thank you, Jim. Great information.
Thank you, Roberta. Thanks for calling in. And then we've got Sandra. Sandra, how you doing today?
You're on mute. There you go.
Go ahead, Sandra.
I think she's on mute.
Yeah. No, she's got to unmute herself.
Yep.
Can you hear me
Okay.
now?
Yes, we can.
I'm
Sandra, where are you
sorry.
calling
So
from?
it was the same question that Roberta asked. It was about how to do it, but I see
Oh, okay.
where we can do it.
All right, excellent. Thank you so much. All right. So anything else you guys think you guys want to add? And I do have one more question for Jimmy, but do you guys got any more information on the Main Street Lending Program that you don't think we covered?
I don't. I just, there's a good chance the program could change, probably for the better. And so I think for the right person, whatever that is, I think it would be a good program for people. So it's good that we're educating folks today. and hopefully it gets a little bit more traction. But, I'll just close and say that we did thousands and thousands of PPP loans. We're just going to do a handful of Main Street. So I think most banks that even are participating, this is probably just going to be a select few. So be patient, and hopefully it works out.
Okay. Dale?
I think it's just a great thing for all the BBF members to be aware of, and we really appreciate Jimmy's vast knowledge of it. And I've referred it to several of my clients, not necessarily for business acquisition, but just to be aware of for business expansion, since you don't have to define what the loan's for. I have a lot of clients that I have long-term relationships with that have profitable businesses that can take advantage of it in whatever way they want to grow their business. And I've let a lot of my clients know about it as a professional courtesy.
Yeah, maybe you're not making a commission off of it, but you're doing a nice thing as a professional, letting them know of information and knowledge that you're aware of to help them build their business. And, in the return, maybe someday they'll kind of call you back when they want to sell their business and it's 5 times as big.
Right.
So it's a good thing. Jimmy, I want to talk to you for a minute. This is the first time that we've interacted was in the last week and a half, and I really appreciate that. It was nice getting to know you. I've worked a lot with Tammy Teese down here in Florida, who's works for Live Oak Bank and does some SBA lending. And I really appreciate you spending the time talking to us about the program. When this goes to YouTube, your contact information will be up there so people can contact you if you want. But I want to kind of promote Live Oak Bank, Jimmy, and let people know that you guys are doing the Main Street Lending Program. But at the same time, I don't want you being bombarded by a lot of people calling you where their loans won't be able to work. So what kind of criteria are you looking for, is Live Oak Bank looking at when doing the Main Street Lending Program, so that you can kind of siphon out if it's going to work for you guys or not?
Sure, I appreciate that.
I want to save you time, and I want to save the broker time.
Yeah, I think our minimum loan amount is going to be $2 million. So, we're looking for somebody with a minimum EBITDA of $400,000 to $600,000. We're looking for some decent collateral, right? Other than just blue sky and intangibles. So, depending on how strong the overall business is, intangible collateral could be accepted if it's, some IP or some patents, or, if you have a business valuation of 6X or 5X, the loan amount, we'll take a look at that, on a case-by-case basis. But really, good pre-COVID cash flow, sound business ownership and management team, someone who just needs to get through the next several months, 18 to 24 months past COVID. Hopefully we'll all be back to some normalcy by then. And that's really what we're looking at.
What states do you guys will do this program in?
We will finance all 50 states and the territories of the United States.
All right, great. Well, I think that about wraps it up. I really appreciate, Dale, you joining today. Congratulations on getting a $2.65 million deal done using this program. Dale did say before we got on here, with his commission check, he's going to buy us all drinks. No, he didn't say that. But congratulations to you, and I really appreciate you sharing with us. And Jimmy, thank you so much for taking time out of your busy day. I know it's been crazy for you guys trying to wrap things up, and with the deadline that's been approaching with the SBA loans. So I appreciate you guys taking the time out. And for those of you guys that are listening, I really appreciate you guys listening today. And as always, work hard, work smart, keep making those buyer-seller connections. And if you haven't done so already, please subscribe to the YouTube channel. It'd be greatly appreciated. And we'll see you next week. Thank you.